Let me welcome on board Vetri Subramaniam, who's joining us as well on the show today. Vetri, good morning. Great to have you with us. Lots to discuss. Every day we seem to see something new playing out, as we saw with the cryptocurrency last night. That brings to question, of course, what's happening on the dollar, perhaps how this reaction on Bitcoin is linked to what we're seeing on the dollar index and what that could then mean for flows and for emerging markets. Let me start off with that just to kind of get a sense of the global backdrop and how you're perceiving it.
So I think the first thing to keep in mind is that actually the global backdrop is pretty solid. Remember, the kind of fiscal support which has been given in the developed economies is unprecedented. And to that extent, and of course, emerging markets, including India, have not been that aggressive because we don't have the ability to be so aggressive on the fiscal side. But effectively, therefore, I think, the global economy, as we get through vaccinations, remember the US says, pretty much all adults willing to get vaccinated will be vaccinated in the next 2 months' time. So I think we're increasingly looking at normalization of the global economy. India this quarter is going to be difficult, but the overall outlook, given the supportive fiscal policies and of course monetary policies as well. The Fed still talking about rate hikes way out into 23, 24, and waiting to actually see growth pick up before acting. I think all of that sort of leaves the global template very supportive and for a pickup in global growth, which should be good for India as well.
Okay, great. So talking about normalization, and we've been trying to dissect this as to what the market is looking at in terms of data on the recovery. And yes, the second wave does seem to be peaking. Is it too soon to get comfortable with that thought, Vetri, that perhaps we're going to start to see a rebound, by perhaps August, September, or the fall?
Well, I'm not an epidemiologist, so I can't really comment on those curves and the way they behave. But certainly the data we see suggests that, things have started to get better in some of the states and metros, which were early to get hit. But I think, this is also a global context that we should be aware of. Look, we're not the first country to experience a second wave. You look at the US, you look at Europe, there have been second waves, there have been third waves. It's not like those markets necessarily reacted. I'm not trying to understand the moral persuasion of the market or provide a narrative. It is what it is. Markets have powered through second waves and third waves in other parts of the world. We seem to be doing the same. I don't have an explanation for it. I don't need an explanation for it.
Vetri, while we are struggling to understand which way the disease is moving, the second wave will have a higher collateral damage because of the impact, because of the impact on young people. Are markets factoring that in, or markets currently are oblivious to that? I mean, what I'm trying to understand is that there's a difference in optimism and complacency.
I'll go back to what I said earlier, Nikunj. Go back and look at the data. We are not the first country to have a second wave, right? You had a second wave in the US all the way through November and December of 2020. Look at the market action over there. It didn't respond to that at all. So, as I said, I can't explain it, but that's the way markets have behaved all over the world. So, this is very painful. There has been loss among those near and dear. Very, very tragic. But, this is the way markets have behaved. So there's no point, unnecessarily ruminating over it. Now, if you're coming to the fact, will there be a setback to the GDP data that we were looking at in the forecasts a month or 2 months ago, the earnings forecast? I think certainly there's going to be an impact, depending on the part of the country. We've lost 6 weeks to, upwards of 8 weeks of economic activity. You think about the year being 52 weeks, effectively you're chopping 10 to 15% off that GDP number. So, I think if you've got real GDP estimates of double digit, 11.5%, 12%, they're set to drop well below 10% without a doubt. Only good thing, if at all, from a data point of view, is remember that the April-May period is anyway a quiet period in terms of economic activity. So while there is a setback, it's not as dramatic as if the setback were to have happened in the Jan-March quarter. So if you're going to see those GDP estimates cut, you've got name the automobile company, name the retail company. They're all telling you that only about 30% to 50% of their retail outlets have been functional in many parts of the country in recent weeks. So, is that going to affect earnings? Without doubt. You've got a 36, 38% Bloomberg consensus EPS growth for the Nifty 50 in 22. Is there a risk to that? I think certainly if you look at the domestic cyclical areas, there is risk to those earnings numbers. I think you alluded to this earlier. Some of the commodity companies, which are driven more by what's happening in a global context, and they are price takers of the global prices, they might actually surprise to the upside in terms of earnings. But I think the domestic cyclical is weak, and therefore there will be cuts to those earnings estimates as well. But again, Nikunj, let's rewind here, right? Let's go back to the narrative as it was in perhaps the middle of February after the budget. A lot of optimism, and some of those factors have not gone away, whether it is a record low tax rate, whether it is record low interest rates, whether it is supportive fiscal policy in India, and some of the reforms that the government has carried out over the last year. To my mind, if the medium-term economic uptrend starts to get questioned, that's when the market will run into a lot more in terms of challenges.
Vetri, the big difference between last year, which is an example which all of us are referring to, is that commodity prices were lower. Now commodity prices are unlikely to give you that kind of an uptick from these levels. So what will lead the recovery?
Well, I don't think you look for a recovery to commodity prices, Nikunj. You look for economic activity to pick up. And we did see that by the time we got to Jan-March 21, which is the quarter that got over, activity levels had more or less rebounded and actually were ahead of the pre-COVID levels of activity. So I think that continuing cyclical recovery, as you see demand come back in some of the consumer cyclical areas, and as you start to see some investment activity, both aided by government as well as by the private sector, though I think the private sector is going to be slow to this, but as it sort of starts to revive, that's the trajectory of the medium-term improvement in economic activity. The reality, Nikunj, is that, even before the pandemic, if you go back to 18-19, India was already in a period of deceleration in terms of growth. And then the pandemic brought everything to a grinding halt last year in the first quarter. And we've been in some kind of recovery since then. If you look at the high frequency data that we've got in May, of course, activity levels have come off, but they've not dropped as sharply or significantly as they did in the first quarter last year. So, I think we can get through this in terms of normalization of economic activity. And we've seen the experience in other countries as well. You do get a second wave, but then the second wave also tails off. And that's the opportunity for the economic activity to sort of normalize.
A lot of PSU stocks, Vetri, they got re-rated. Value buyers call them as cheap. Then there was this opportunity which came out because of the government's divestment process. But because of pandemic, a lot of assumptions will get challenged. Let's say the disinvestment of BPCL or Air India or SCI will run into rough weather. What happens to PSU stocks now?
Well, my first input would stop thinking about stocks from an ownership perspective. Just sort of, blindly saying PSU versus private, I think you're missing the whole point. It comes down to actually looking at companies in terms of those who have the fundamental ability to grow. And if you do among the PSUs, I would say it's a narrower set of companies who are actually fundamentally strong in the sectors that they operate in, then you could make a bottom-up case for investment in them. But I'm not a fan of this, broad brush, okay, now we need to look at PSUs. The only good thing on the PSU front, so to speak, which comes from the ownership perspective, is that Government of India has sold as much as it can of companies and brought its shareholding down to 51% in almost large number of enterprises. So that flow of constant supply is certainly something which has gone away. But that doesn't mean that you stop looking at individual merits of companies before buying them. So I don't see things like a PSU wave, or certainly not the way that I would approve of looking at investing in stocks. If we find sectors in which some of the PSU companies are very, very competitive, if Government of India is genuinely looking to privatize them, and we believe there is an opportunity, we do own some of those stocks, but it's got to be a bottom-up case. It's not just a simple, let's buy all PSUs or let's not buy PSUs.
Vetri, hi, good morning. Wanted to get in your take as to what the outlook is on the entire commodities basket, because they have been on quite an unprecedented bull run globally, and that bull run is expected to extend. How are you looking at listed players within this space in light of what we're seeing going on?
Yeah, that's a interesting question, and I think clearly the run-up in commodity prices has been dramatic across the board. You've got many of these, the whole metals mining sector prices at record highs, profitability at record highs. Interestingly, even agri commodities have, I think if you look at the FAO's agri price index, it's up 70% over the last year or so, and therefore there's a boom happening there as well. Pretty much the only commodity which hasn't sort of gone ballistic to record highs is oil, which is not necessarily a bad thing. It's a good thing from everybody's point of view. But I think there are some challenges here in terms of the interpretation. If you look at things like steel, China accounts for 50% of global demand and supply roughly. And you've got that economy now clearly sort of trying to readjust itself, both in terms of the fact that they would like higher quality growth, more growth led by technology, rather than the old smokestack style-driven growth that you saw in the previous decade, right? They've talked about this. So to my mind, beyond the point, this sort of run-up in commodity prices is going to run into a very simple challenge that the biggest driver of demand, which has really been China, is not looking to grow its economy the way it has in the past. Also, the transition from very poor profitability to a high level of profitability has been very, very sudden. When I look at some of the EBITDA margins that steel companies are making in India today in rupee terms, these are absolute record levels. And when you've gone to record levels in terms of profitability, then I would tend to get a little muted in my excitement about these cyclical companies. Looking at the P's and the EV EBITDA at this point of time is meaningless. When you look at cyclical companies, when commodity prices are high, when EBITDA margins or EBITDA per ton is at a record level, actually you will see valuations start to correct because they need to come back to the average cycle level. In a way, commodity companies, you buy them when margins are very, very low, and stated P's or price or EV EBITDA may be very, very high because of suppressed profitability. So the cycle has been very dramatic. It's already played out phenomenally over the course of a year. I would hold my horses given the transition in profitability and given the fact that China is not going to be a global driver of demand in this complex going ahead.
Do you have any thoughts then, Vetri, on some of the other sectors like roads, railways, urban infrastructure, housing, etc., especially in light of the kind of incentivized investments made by the government? You had the PLI scheme as well coming in, and this, even the Atmanirbhar Bharat initiative, all set to benefit a host of these sectors. Your thoughts?
Sure. I think housing is interesting. What people don't realize is that the housing sector is almost about a quarter of total capital investment that happens in the economy. It's been a soft spot for many years, but nothing like record low interest rates and the sort of tax breaks and etc., which have been given both to at an individual buyer level as well as to developers to get the real estate cycle moving. So that is something that incrementally we would tend to be positive on. If there is a part of Capex that incrementally we are positive on, I would say more positive on it happening in real estate than necessarily with the private corporate sector at this point of time. I think the other sort of interesting area would be at some level automobiles. If you actually think about automobiles, it's been through a very difficult cycle. going back all the way to the festival season of calendar 2018, right? So you've seen 3 years in which volumes broadly have gone nowhere or they've gone negative. And this in an area where, we still think that the structural growth story in automobiles in terms of the demand that's likely to come from consumers as they move up the income cycle and look to sort of improve their quality of life in an automobile, we think that structural story is still intact. And therefore, this 3-year adverse cycle actually is creating a good opportunity to position for, demand normalization over there. So that's again an area we like. The domestic healthcare sector and pharmaceuticals, the sector has done well in the last 1 year, but really it's coming through again a period of 2-3 years of intense pain. They've had to readjust their business structure. The domestic opportunity remains very, very attractive, but they ran into significant challenges on the pricing side in the generic markets globally, and also with quality related issues. One by one, we are seeing companies sort of address these challenges and get past it. And remember, these companies are globally very, very competitive. I mean, it's one of the few sectors in which you will find a large number of Indian companies globally competitive. So again, that's an area that, we're still quite excited about. The entire pharmaceutical plus healthcare space, automobiles we talked about, real estate is another good area where I think you will see incremental numbers looking quite positive.
Interesting. Vetri, I don't know if you just touched upon pharma right towards the end there, but is that a space you're not so bullish on, or do you feel perhaps it's just topped out?
No, as I said, pharma and healthcare is something that we still like. As I said, the domestic market opportunity is still very, very attractive. It's highly profitable. It's got very good growth characteristics. It's just an unfortunate fact of life that as incomes go up, you get more and more of chronic lifestyle related conditions, which require a lifetime of treatment. It's not 5 days on an antibiotic course and then you're done. So this is a good growth opportunity for the domestic companies. And added to that is the organized sector of healthcare, which is the whole hospital diagnostics place, which again is growing on the back of spending ability and the development of the health insurance sector. So we're quite positive on this domestic healthcare space. And as I said, the export end of that, which had been challenged by safety issues and also quality issues and also by pricing issues, we think the worst is sort of behind on that front as well. So this is a sector where we would stay incrementally positive in the medium term.
Great. And within financials, Vetri, what's the strategy now? How are you looking at it? Are you reshuffling? What are the kind of parameters you're applying when it comes to the financial basket?
Yeah, that's an interesting question, right? So financials has been the bellwether of this market. It's, of course, the largest sector in the benchmark, but, it's obviously gone through a difficult period over the last year and a half, particularly because of the pandemic. But just 2-3 quick points here. This is the first time in almost 20 years, I'm actually seeing the fact that a handful of banks have been proactive in terms of providing for potential losses. Remember, they actually started providing for losses in the March 20 quarter when the pandemic had just about hit, right? Secondly, they went out and raised capital as a preemptive measure to strengthen balance sheets. Thirdly, many of them have built excess buffers within the P&L. We've not seen this kind of behavior from some of these banks. If you look at the previous, credit cycle, 2013-15, or even if you go back to the late 90s credit cycle, typically the attitude was deny, regulatory forbearance, and then you wait 4 to 5 years before you start to clean it up. Now, some of the points that I made may not be true of every bank within the sector or every financial lending institution within the sector, but certainly it's true of a handful of those institutions. So, while at a sector level, it's hard to get dramatically overweight given that the sector is already 32% of the benchmark, we think we are within that selectively very confident that there is a strong consolidation story that's going to play out. Some of these institutions who navigated the credit side and the asset side risks well over the last 1 year, they've built their buffers, they've got high capital adequacy, and they've got the trust of depositors, or they've got the trust of the bond markets. I think the case for incremental growth accruing to them is far stronger than anything I've seen in the last few years. So you have to be cautious within that aggregate sector, because companies are very different. But there's a handful of 5 or 6 where I think, we are personally and many of our funds are, invested in them with a strong active weight, because we think these guys are going to come out of this difficult period with their foot on the accelerator, better margins and gains in market share.